Reserve raised the interest rate 75 basis points, the largest one-week jump in 35 years.
That interest rate change has a lot of people asking questions about mortgages and their finances. David Hochberg is the vice president of mortgage lending at Team Hochberg at Homeside Financial, and he's the host of Home Sweet Home Chicago on WGN Radio Saturday mornings. Did I get every one of your titles in there?
Pretty doggone good, yeah. 10 to 1 on Saturday mornings on AM 720 WGN.
Okay, good thing we own them too, so we're not promoting somebody else. Artie, so when people talk about, like, you know, housing correction or mortgage rate changes, I think we all immediately jump back to 2008, but this isn't that.
It's a completely different market. In 08, we had an oversupply. We lost about 40, some areas lost 40%, some areas lost 60 to 70% of value. We don't have the oversupply like we did in 08. It's the other side. We don't have supply. That's why values on homes have shot up. So it's a completely different set of variables from 08 until today. So we're not going to, I think we're going to see a pullback. All industry experts are going to see a pullback. The big banks that are offering home equity line of credits have already pulled back what they're offering. Home equity line of credits, they used to go to 90%. Now they're going to 80 and 85. So they see a 5 and 10% correction on the horizon, and it's just, it is what it is. We've had such a hot market.
It was so hot. A house would go up for sale and then it would be gone a day later. Now with interest rates creeping up, how high do you think they'll go?
You're probably looking at 7% in the near future. Yeah, I was talking with our listeners on the radio saying you got a better shot of seeing 5% than you do 3%. And then I said, hey, and they're like, oh, you're crazy. I'm like, yeah, you're right, I'm crazy. Now you got a better shot of seeing 6%. I told them instead of 4%. And then I just came out a couple weeks ago. I'm like, got a better shot of seeing 7% than we do 5%. So we're on a upwardly mobile market here, and it'll change eventually.
The adjustable mortgages are a little bit lower, but I know that some people are kind of nervous about that. They think I want to be locked in at the number I'm supposed to be and not have to worry about it.
Yeah, it's like buying a 30-inch belt for a 30-inch waist, right? So a lot of
now you're talking a language I understand.
Back in high school, when we got into 30-inch belts, when we knew what those were. No, it's like, you know, do you want a 30-year fixed loan? Most of our viewers are only going to live in a home for 7 years, right? If you've got kids going into high school and you know that as soon as they get their diploma in 4 years, the for sale sign's going on the front lawn and you're out, then why not go into a 7 or 10-year ARM and pick up the quarter or 3/4 of a point savings? And then when the market adjusts in 2 to 3 years, when rates come back down, we'll just refinance you into a lower rate. So the adjustable rate mortgages are nothing to be afraid of. I went into a 10-year ARM, and I just refinanced in January, closed my loan. I went into a 10-year ARM, and I do mortgages. So there's nothing to be afraid of.
Well, and perspective is also so important. I was actually talking to my father-in-law about this last night. You know, well, we all freak out when you say could go to 7%. The reality is, a few decades ago, we were way into the double digits.
I bought my second home in Valparaiso, Indiana. 7% 30-year fixed loan. That was in 1980 something. I forgot what it was. Bought a townhouse in Valpo. Then I moved back to Chicago, and it was like 6.5%. So it wasn't too far, far back where rates were in the 7s. And again, what goes up comes down. I've been doing this for 21 years. You know, we've done some stuff in the past. Rates go up, rates come down. And when they come down, your mortgage professional, if they know what they're doing, will call you and offer you a lower rate and refinance you into a lower rate.
Which helps tremendously. So I know we have a viewer question here. An email from a viewer says, my husband is 78, I'm 67. We owe $210,000. Our rate is 5%, and our home is worth $500,000. We're retired on a fixed income, limited retirement savings, and struggling to cover our monthly expenses. David, please help.
We're getting a lot of these calls from experienced homeowners that are on fixed incomes that are getting crushed due to the economy. And what we're recommending, this couple, I talked to them, do not qualify to refinance. If we did refinance them, we'd refinance them out of their 5% into a 6%. That didn't make any sense. No. So walking through a reverse mortgage, a lot of our listeners are scared to death of a reverse mortgage. There's nothing to be afraid of on a reverse mortgage. This couple, the biggest concern is the bank's going to own my house or the government's going to own their house. The bank, if you use that logic, technically owns your house right now. They still owe $210,000. We're just putting a new mortgage behind it. And the government, if you haven't figured it out yet, has got more things going on. They don't want Sally's house, okay? They got a lot of other challenges. This couple would save $1,300 a month. It's scary to a lot of our viewers, but talk to a trained mortgage professional that has got experience in reverse mortgages. After I talked to them for 10, 15 minutes, dropping my kids' bags off for camp on Friday, they were like sold, and we're going to pull an appraisal and see if we could save $1,300 a month. It's a great product. when used
$1,300
effectively.
is nothing to sneeze at.
It's a lot of money.
Yeah, it's good.
Yeah, it's a lot of money.
Thanks, David.
Thanks for having me.
We appreciate it. David Hochberg. If you'd like to contact David about a mortgage, you can check out his website, 56david.com.